If you're an asset owner or a consultant using or considering using factor risk models, this video discusses the major limitations of the conventional bar-type models. That is, very little of the interesting new data are actionable by allocators. Here's what allocators can do with conventional models. You can very accurately estimate a portfolio's current risk relative to its benchmark, its future tracking error. And you can measure the impact on aggregate portfolio risk of including or excluding an individual fund. This is definitely useful, but it's really all you can do. Well, there is one more thing you can do. You can use the individual factor risk estimates to create some visually interesting data and graphics. There's one big limitation, though. You can't actually do anything with the information. Here's the problem. None of the factors are directly investable. There are no passive investment equivalents for any of the factors in the conventional models. So as an allocator, you can't offset any factor exposures you don't want, or obtain the exposures you want but don't have. And it won't help detect manager skill because you can't argue that factor exposures aren't part of active contribution when you couldn't have gotten those exposures passively. Again, very useful to investment managers who can offset unintentional exposures by resizing positions, but not terribly useful to allocators who cannot. But imagine equally robust models that use a much smaller number of factors, all of which are investable as passive ETFs. Our approach is statistical rather than fundamental, 10 rather than 130 factors, and definitely more intuitive. We model over 140,000 securities on a daily basis to estimate for each, first market exposure or market beta, then sector beta, which is net of market impact, then size beta, which is net of both market and sector impacts, and so on. And by the way, because all these factors are, by definition, uncorrelated, we avoid the collinearity problem that caused the conventional models to all blow up in March of 2020. More importantly, though, since all these factors are available passively, allocators can now offset any unintentional risk exposures, and they can obtain the equivalent passive risk exposures of any active fund. So now, factor exposures are not part of active contribution. Anything that can be replicated passively is clearly not worth active fees. We can still measure risk relative to a benchmark, but we can also distinguish the portion of risk due to security selection from that due to passive exposures that are simply different from those of the benchmark. The data in this chart represent the median active fund, in which passive exposures explain about 2/3 of risk relative to a benchmark. This is the reason we've never been able to detect statistical evidence of skill in performance data. But now, for the first time, we can accurately separate active from passive contribution and isolate the signal from the noise. Typically, 2 or 3 market factors explain the majority of passive risk. If these exposures are unintentional, and they likely are, offsetting them reduces tracking error without sacrificing active risk. It's a free lunch. And just as we can define how much individual factors contribute to relative passive risk, we can also define how much individual stocks contribute to idiosyncratic or security selection risk. Surprisingly, less than 10% of holdings usually explain the vast majority of security selection risk. And sometimes it's the stock you don't own that matters the most. So, to summarize, when factors are available passively, we can accurately distinguish active from passive performance. For the first time, we have an attribution that is both meaningful and actionable. We can separate past performance and also future tracking error into a passive component due to consistent beta differences from a benchmark, a timing component due to changes in betas from their long-term average, and security selection, risk and return unique to the security selected, net of market impacts. And keep in mind, components can be further broken down into each individual factors and each individual security's contribution to both past performance and current risk. We can offset unintentional passive exposures and reduce tracking error while retaining the security selection risk worth active fees. we can confirm that managers take sufficient security selection risk to compensate for fees. This is important because over a third of active mutual funds take too little active risk to ever overcome fees, even with skill. An active share will miss 80 to 85% of these. And when we isolate security selection performance, we can, for the first time, detect statistical evidence of skill. Funds with top decile information ratios are twice as likely to outperform over the subsequent 3 years. Funds in the bottom decile are more than twice as likely to continue to underperform. These are just a few of the many ways these models transform oversight. I know, talk is cheap, but one nice thing about risk models, their accuracy is easily proven in advance. We'll provide replicating portfolios for any of your funds, and you can compare returns predicted by current factor exposures with the actual fund performance over the next several weeks. You'll find that our models are every bit as predictive as the conventional models, just a lot more useful to allocators. If this sounds like it could be worthwhile, take a test drive. We've found that the aha moment often happens while trying the models for yourself. The interface is pretty intuitive, you don't need a manual, and there's zero obligation. Just email us and we'll send you login instructions.